What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series, where I use all of the current market volatility to find you guys 3 new stocks that I think are on sale at today's prices for the long term. And to make things even more fun and interesting, I specifically look for one low risk, one medium risk, and one high risk stock, just to give you an even wider variety of different stocks to look at and consider depending on risk versus reward and everything else. But as always, just remember to please do your own research and make your own decisions. We only do this for fun, and I'm just trying to look for different stocks that are out there in the market to show you what's available and out there. So if you do appreciate that, though, please consider hitting the like button and subscribing to the channel. Those 2 things really help me out a lot and keep the channel alive. But with all that said, let's go ahead and jump into today's fresh new list of stocks. Alright, and starting here first with our low risk option, this time it's going to be the massively large and unbelievably dominant Amazon, ticker symbol AMZN, who is currently trading at some extremely attractive levels, which I think is setting them up for a huge recovery, and I'll explain why in just a second. But first, just a really quick intro into why Amazon is such a great investment in the first place. Well, they already command over half of all US online retail sales at over 56%, while the next closest competitor in Walmart is only at around 6%. That's pretty crazy. But it makes sense. I mean, at this point, shopping on Amazon is becoming as common and popular as searching something on Google. I mean, almost every time that I think about buying something, I find myself immediately opening up the Amazon app to check prices, reviews, see what different options are available, all kinds of things. In fact, speaking of Google, Amazon actually controls more search market share when it relates to product searches, and it's at over 50% of that entire market, which is very impressive. So basically, anytime someone wants to search for a product, they actually go to Amazon first rather than Google. Plus, that dominance has even helped Amazon break into the online advertising market that was previously controlled in a duopoly by Google and Facebook. But because Amazon has been growing their ad sales by such a fast rate, they've already gone from around 7% market share in 2019 to about double that amount expected next year, which, by the way, has also mostly come at the expense of Google, who dropped from the 30% range down into the mid 20s. I mean, at this point, you should probably start referring to this as a triopoly with Amazon included. Even in the most recent quarter, Amazon grew their ad sales by a much higher rate than literally all of the largest competitors at a whopping 18%, while Google grew by a smaller 12%, and Facebook was actually negative. Speaking of growth, though, this is a company that already generates a mind-blowing $500 billion in sales, yet it is still growing by double-digit percentages. That alone is absolutely crazy to think about, but revenue is not the only thing growing. Thanks to their gigantic cloud platform that generates the bulk of their profits with Amazon Web Services, it already controls about a third of the entire world cloud computing market, and yet still somehow managed to grow by over 30% last quarter. Well, it's helped their net income actually triple in just the past couple of years. Yet despite all of these amazing feats, the stock has actually crumbled recently because of the broader stock market crash, leaving them down around 40% from their highs. For a company like Amazon to lose almost half of their entire value, in my opinion, that's pretty ridiculous, and analysts seem to agree with me, as it's not only trading at about the same prices as the lowest estimates, but the average is also significantly higher, while the highest estimates are about double the current price. And that's pretty crazy for a company that's already worth more than $1 trillion by market cap. But I still love it here for not only all the reasons I already gave you that make Amazon such a great long-term investment, but also because we're about to hit the holiday season where consumer spending tends to skyrocket, and horrible economy or not, Amazon is almost always the best place to shop for both low prices as well as convenience. And if there's one thing that I know everyone is going to be wanting this shopping season, it's going to be low prices because of the horrible macroeconomy, and convenience because of how busy we all get during the holiday season. And Amazon, I feel, really offers you both of that, saving you both time and money. I'm not saying that the stock is going to shoot up immediately as a result of that, but it's a good tailwind to have for them. And overall, I still think Amazon is just one of the safest bets, if not the safest bets in the entire market, especially long term. And it's already my third largest stock, and I still find myself wanting to buy more Amazon stock on occasion. I happen to really like it. Okay, moving on though to stock number 2, that's going to be our medium risk option, which includes an attractive dividend to help lower the risk a little, since a falling stock price means a rising yield. And this time I'm going with a biotech that I actually own myself too, in AbbVie, ticker symbol ABBV. And let's just cut straight to the chase. AbbVie has one of the best growth-oriented dividends in not just the pharmaceutical and healthcare sector, but even across the entire market, as their dividend currently yields over 4%. It has a small payout ratio of less than 50%, a monstrous growth rate of over 17%, and despite what it says on here, AbbVie has actually grown their dividend for a gigantic 50 years in a row, which does qualify them for dividend king status when you include the years prior to the spinoff from Abbott Laboratories. Now, unfortunately, the stock has not sold off quite as hard as so many other stocks in the market, but it's still down a pretty considerable amount of well over 20% from the highs, and currently sits in the bottom half of its 52-week range. Plus, gigantic crash or not, AbbVie's valuation is still very attractive, with a PE ratio that is 30 to 40% cheaper than the rest of the sector. Now, business-wise, AbbVie has been able to generate monstrous growth over the years, which has helped fuel that mouth-watering dividend. Ever since they were spun off from Abbott Laboratories in 2013, AbbVie has been able to grow their sales and profits on average by around 15% and 19% respectively per year, which is super impressive. However, a big contributor to that growth was the major success of their rheumatoid arthritis drug Humira, which has been the best-selling drug in the world for many of those years. In fact, the only reason it was knocked down to second place last year was because of the pepperoni V shot from Pfizer. The issue, though, is that Humira is losing patent protection now. Out of the nearly 250 patents that AbbVie holds on Humira, they've already lost about half of them internationally, which caused their international sales for the drug to fall by almost 14% last quarter, so it's dropping pretty hard. And most of their US patents are also set to expire next year, which will hurt their sales even more. However, there's a number of ways that AbbVie is making different moves to help mitigate these and losses and help make up for them. First of all, AbbVie has been working some legal jiu-jitsu to make sure that over 100 of those patents remain intact for more than a decade longer. So while the sales will fall, they're going to fall by a bit less than was previously expected. And even when they do, AbbVie has been investing heavily into new products to make up for it. Take, for example, two of their hottest new drugs in Skyrizi and Rinvoq, who grew their sales by over 80% and 50% respectively last quarter, and AbbVie projects them to one day generate more sales than peak Humira. Now, not to mention the other 6 blockbuster drugs already in their portfolio, the gigantic pipeline of new products and repurposings that they've been working on, and the giant acquisition of Botox maker Allergan that immediately took down Humira's dependency from 60% down to 40%. I think today it's closer to 30%. Plus, the deal sent their profits soaring, with operating cash flow growing from around $13 billion before the acquisition to almost $18 billion the very next year. And today it's closer to $23 billion. So by all accounts, AbbVie is still a cash generating machine, and while their sales are expected to dip next year because of the Humira patent losses in the US, most analysts still think that this is only a temporary setback before AbbVie moves past Humira dependence and returns to higher growth, hence why the stock is currently trading at the lowest analyst price targets right now. The risk comes from the fact that you're not going to get much growth out of AbbVie right now because they are going through a transitional phase, but the value comes from the great, the really cheap valuation, because the stock is already down a bit. It was already cheap to begin with. And you also get a very attractive dividend that is already a very high yield, and yet it's still very safe. And so even through the transitionary period, you at least get to collect that dividend as well while you wait for these other things to take shape. So overall, it's just a pretty good, decent stock. I would say medium risk. AbbVie is a good fit for that category. All right, guys, that's going to leave us now with the third and final stock, which is also our high risk option. And for this one, I'm actually going to go with another dividend stock. In fact, believe it or not, this one actually has a higher yield than even AbbVie. But Unlike AbbVie, I do not currently own this stock myself, at least not yet. And this stock is the pharmaceutical and healthcare retail giant Walgreens Boots Alliance, ticker symbol WBA. Now, you guys probably know of Walgreens because of their many brick and mortar retail stores, about 9,000 of them across the United States and around 13,000 globally thanks to their merger with Boots. And these are general pharmacy stores where you stop in to get your prescriptions while maybe adding on various other health related drugs and products, or just typical convenience store types of goods. Now, normally I would immediately dismiss this as a horrible investment because of the rise of online shopping through the likes of course, Amazon, who we just previously spoke about in this video, and the subsequent retail apocalypse that's been going on. However, Walgreens, I think, does have a shot of surviving this, and I'll give you a couple reasons why. First of all, Walgreens essentially acquired Village MD last year, which is a primary care business that has seen very high growth in recent years. And now that Walgreens is a majority owner, they'll be leveraging that partnership to bundle health services with their own retail pharmacy operations. That means that Walgreens will no longer be just a typical brick and mortar pharmacy company, but a more essential business that also provides healthcare services too. And no matter how horrible the economy is, healthcare and pharmaceutical drugs are things that will always be needed. So the idea of Walgreens ever going out of business is becoming less likely, as Village MD already has 120 clinics, while Walgreens is planning to expand that to 1,000 locations by 2027. They've also been investing in Walgreens Health, which is their fastest growing segment that works on improving access, engagement, and convenience for all things health related. This includes further investments into CareCentrix, which is a technology and healthcare coordination company that helps manage the care between patients and doctors, especially after they leave the office. And their platform helps them stay in contact. It coordinates more effectively with pharmacies. In this case, obviously, there will be a ton of synergies with Walgreens, and they even manage healthcare from home as well as rehabilitation and long-term care facilities. And with already 19 million members, these new services should add even more stickiness to the Walgreens ecosystem while also improving their margins and helping them retain customers over the long term. Now, having said all of that, I still consider Walgreens to be very high risk because the business is extremely low growth. I mean, their sales and profits are essentially flat over many years. And while I do think that their recent investments are things that are necessary moves in order for them to survive, and I do like them, these investments are still costing them a ton of money. So don't expect to see climbing profits anytime soon. This is by all accounts a transitionary period for them that will take several years to complete. However, the only reason I choose to include them in today's list is because I think the selling is overdone at this point and the stock is starting to look like an amazing value play from here. Not only has the stock already lost more than half its value over the past 5 years, which is significantly lower than even the lowest analyst price targets, but that crash has also left them with a dirt cheap valuation that is around 70% cheaper than the sector, while their mouth-watering dividend has also soared to a record high yield of over 6% as well. And yet, despite that monster yield, the dividend is extremely safe at a super low payout ratio of only 35%. And by the way, don't pay attention to that growth history there on Seeking Alpha. It's actually, that dividend has been paid for almost 100 years in a row, almost an entire century. And it's also been grown, the dividend has been grown every single year for almost 50 years in a row. It's almost a dividend king at this point. And so that dividend is extremely attractive. You're also talking about that great valuation and you've got some turnaround potential. There's a lot to like about Walgreens. The problem, the high risk, comes from the fact that it is extremely low growth and the business is still in a turnaround transitionary period. So you're taking a lot of risk there. And the stock has always been, a pretty bad performer, at least in recent years. So you're taking some risk there too. But, I think at the very least, it's a very interesting stock to keep an eye on. And I really enjoy tracking it. And I could actually see myself wanting to buy some at some point. It's definitely very tempting, especially with that high yield. But anyway, That's going to do it for today's episode. What do you think about all of these stocks? Do you have any opinion? You own any of these? Have you thought about any of them? And what stocks are you buying? Let me know down below. I may include them in a future episode. But thank you so much for stopping by and for all the support. I really appreciate it, guys. Hope you're all doing well. And I will catch you in the next one. Take care. Bye-bye.